Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Very excited to have everybody here today. We're trying to help people improve their retirement, and we do that by answering your questions. You can send those questions in to Ask Tom at talkmoneywithtom.com right now. We'll try to answer them live. You can put them into the chat. You can send those questions during the week. We answer questions that came up in our strategy sessions with our clients. So really, whether you're retired already or looking forward to retirement, a lot of these questions apply to both groups. And we believe that the more you know, the more successful your retirement can be, especially in the financial area. The more you know about retirement planning and asset management and tax planning, the better. And so we created this channel. You can subscribe to the channel, kind of bookmark it that way, and be able to even hit the bell if you want to get notified when we put new content on. Or you can just meet with us if you'd like also. You can go to our website, book appointment button just like that up in the corner. And you can pick a time to meet with Ethan and I, on the phone, a video in the office, whatever you'd like. And we can try to answer some of your specific questions that way. So really good day today. Looking forward to being able to kind of help you out. Of course, going to start off with a summary of what we kind of saw happening this week. And so first off, let's look at the stock market for the time frame from the very high back at the beginning of 2022, you can see there, all the way till today. And so really amazing time frame. Obviously had a big downturn, lots of running upward, down motion in the end. And this year has been fantastic altogether in comparison to last year. And today we're sitting at the high for the year. And it's been a couple weeks since we had our last show. And what we talked about at the last show has played out almost perfectly here over this 2-week period, because we talked about how, we'd had that big run up and it was Friday, kind of triple witching Friday, with the options expiration. And then we have the end of the quarter, which is when all these big funds tend to rebalance, right? And so if you're a big target date fund that's supposed to have 60% in stock and the stock market does great and it gets to 65, at the end of the quarter, you might be selling that extra 5% and buying something else. And if you watch closely, we exactly had that happen. The bond market was kind of doing okay during that time. And I think, again, the stock market was coming down. And if you looked really closely, even within the stock market, those things that went up the most got hit harder because, again, if it's tech stocks, which had a really big run, they would get hit even harder. And then we finally hit that low point. And during the daily videos, I was talking about maybe the 28th, we would hit that low because that's pretty similar to what happened in previous quarters. And we actually hit that low the 26th and started to take off. Now, we have signals that we use for the stock and bond market. So our stock market signals right now are both green. But we did get on the fast signal a yellow signal during that downturn. And so one of the things that you have to think about is kind of, what's going on. And it's kind of funny. I listen to CNBC and Bloomberg radio, just like everybody else. And during this period of time, I kept talking about the rebalancing, and that once it's over, it could shoot back up and get back to a new high and all these things. But when you're listening to the news during that downturn, the news tends to attach things to a downturn. So they're losing confidence in tech stocks. Well, apparently not, because they're really flying today, right? So, or whatever it is, they try to do that. And they're not always looking, in my opinion, at kind of the supply and demand issues. If you've got these very large, institutions rebalancing, it's a temporary scenario and what have you too. So that's something I think is really important for what has been happening here over the last couple of weeks. And now we're going into this new high. We have talked, quite a bit about, the reversal of trend, going from that kind of blue line there that's showing that downtrend to now we're seeing this reversal, and kind of the checkbox things that I've had and looking for, and all of those were achieved. We got past the debt ceiling, right? We've got consumer confidence came out today. It was really high. And so the consumer continues to drive this. And we're supposed to be having a terrible stock market first half of this year. If you looked at the articles from the second half of last year, we were supposed to have bad earnings, creating this big downturn, be down maybe 20, 30% from where we are now, right? couldn't be farther from being inaccurate, right? And so what's happening here is that under traditional measures of finance, when you raise interest rates 5+%, like the Federal Reserve did in essentially a year, you're going to have a hard landing. You're going to have a big recession. You're going to have a situation where the stock market does come down pretty heavily.
Yeah, and you can see, like, even though the Fed has raised interest rates up to 5%, unemployment is still low.
Yep.
GDP is still growing.
Yep.
So there's a great possibility of a soft landing that they've been shooting for.
Yeah, I mean, we're essentially having the soft landing right now as it goes. I mean, the middle ground is where we're at and where we've been for quite a while. Things can change.
Yeah.
And we'll talk about how we would respond to those changes. But you're exactly right. This week, gross domestic product was revised up to 2% growth. On an annualized basis, it was supposed to be at 1.4.
Yeah.
Not bad. Unemployment, first-time unemployment claims, which come out every week, were at 239,000. The expectation was 270,000. So unemployment claims are doing well. There's a lot of job openings. Unemployment as a number is doing fantastic. It's very low. Now, always keep in mind, though, because this is one thing that kind of trips people up, is that employment and the job market tends to be a lagging indicator, right? When you look at the leading indicator grouping, LEI, there's 10 indicators in there. Housing starts, that's a leading indicator. So when somebody's applying to build homes, that's a good thing. The S&P 500 is in that grouping. You will not see the employment issue. I actually use an inverse portion of the employment, but nonetheless, things are pretty strong. Consumer continues to drive, and so the reason I think that we're not having this big downturn is because we have this pandemic, which is driving spending, and the motion is moving from goods to services, and that's still going. And obviously, what we're doing is fighting with inflation, and we'll talk about that in a minute too. But that's a really good chart.
Yeah.
I mean, it really is. Things are doing fantastic. I've been saying for a while that, we're now in a bull market officially. We get more than 20% up from some low, which we did here, about 6 weeks ago, I guess. And again, shortest bull market's 2 years. We're 8.5 months into this. Average bull market's 5 years. So because there's still tons of articles talking about how the market's going to fall now in the second half of this year, or maybe the first half of next year. Again, they could be right, and we'll be ready. However, that would be a new record, right? I mean, to fall another 20% from here would then put us into a bear market, shorten this bull market to the shortest ever in history, in the middle of all of this spending going on from these consumers and this pent-up demand. So it's possible. It just seems a little less likely, especially now with the way things are going. So I'll show you just some example here. Let me change views so we can see this a little bit better. This is our 100% traditional model. We have an ESG model, a green model, and traditional model. Traditional is our biggest. And this is our all stock. We don't have a lot of people in this because it's kind of aggressive, but just to kind of show you how the process works, and maybe this will help you. So we have 174 ETFs currently in our universe that we look at, and they're segmented. We got bonds, and we got stocks, and we have core, which are kind of the big diversified pieces that we might put more money in, and we have kind of target, right? And that's maybe more narrow and more aggressive or what have you. So right now you can see that the two big pieces here are both ESG core pieces. Now, this is not an ESG portfolio, so we don't have any real reason to put them in there. It's just that what we do is they compete. And so I look at this like a soccer team, and you've got different players on a soccer team, and they do different things, and that's their specialty, right? And then you got a bunch of people on the bench in each one of those positions. And so they're all competing to get on the field. And so the ESG core pieces have gotten on the field because they're outperforming the other parts. And mainly is because technology has been doing so well. And lots of times when you put an ESG screen on something, you end up with a lot more technology because they tend to make it through those screens. So we have those two pieces, but we also have cybersecurity, our robotics and artificial intelligence. We have an overall tech index, XLK, which is the S&P's 500 spider, tech shares. We have cloud computing, QQQ, which is the top 100 stocks on the NASDAQ in size, and semiconductor stocks.
Yeah, you can see how it's a very heavy overweight to tech and like mega cap tech, I would say.
That's exactly right. And so one of the ways that you can really tell what's going on is to look at this universe and look at what's going. So if things start to do poorly, right, and the markets start to fall apart and these people are right, and we do have this big downturn the second half of this year, the beginning of next year, what will move up will be the more conservative things, your healthcare, your utilities, your treasury, T-bill type things.
Your value stocks.
Value stocks, they'll move up that list, and these things will go back onto the bench, and the playing field will be populated by other players that are performing better at that point in time. And so that's how we do it. We have kind of a rotation that comes out of this universe. The creation of that universe is really important in terms of how you pick what's in there, how many of each thing you have in there, those types of things. And then basically you have this rotation. So it's really, it's kind of self-fulfilling. But I'm telling you, one of the things that helps us a lot is just seeing that universe and seeing what's moving, what's percolating up to the top of the universe. And you can really tell kind of from a broad basis what's happening. And obviously you can see here that artificial intelligence and technology. I said this before, but during the debt ceiling argument, the 7 stocks on the S&P 500 were really running.
Yeah.
And I thought it was because of it's sort of a safe haven, right? And our hope was, and we talked about this, was that there'd be some spread of that money eventually once the debt ceiling was done. And that's actually happening. We're seeing some motion in other areas besides just those big tech names, although they're still doing well. Yeah, so they kind of got a momentum going and people are buying. And obviously there's a lot of different drivers that are going on in the market, but things are going pretty well right now. Okay, so let's look at this. This just came out today.
Yep, this morning.
PCE stands for Personal Consumption Expenditure Index. All right, it's a mouthful. But just know that when we talk about inflation, we're normally talking about CPI, Consumer Price Index, right? And that's the one everybody kind of knows about. It comes out middle of the month for the month prior. This is June 30th. This is for last month, for May. So it's always late. Nobody really talks about it. The reason to know it is because this is what the Federal Reserve looks at. They don't really look at CPI as much as they do PCE, and this is their key thing. So, and there's 2 pieces of PCE as well as CPI, and that is top line, which just means includes everything, and then core. So if you look at this, really nice pattern.
Yeah.
Right? Coming down nicely. This is including everything, 3.85%. All right? And so that's not bad. Now, the Federal Reserve is trying to get back down to 2%, but it's not on this one. It's on core. So in core PCE, we take out food and energy. And the reason they take out food and energy, because the Federal Reserve says that they feel like they don't have as much control over those 2 categories with their interest rate increases. And they really, they're more volatile aspects anyway. Sometimes they can give some false signals. And so if you look at core, though, it's a lot stickier. Yeah. And it's at 4.62%. That's what they're trying to get to 2%. So here's the thing that I would be watching, because so many of the articles are talking about recession, right? Recession, based on the interest rate increases that have already happened. I would probably refocus on inflation, because if you look at this core is hanging in there, and the market is now flying. We're up, 25% off of that low back in October. People are starting to feel wealthy. Consumer confidence just hit a really high number, right?
Yeah.
People are getting out there. That's inflationary. And I think that's probably what I wouldn't be surprised to see this come back up at some point in time. And what that's going to do is create some issues for the stock market, in the sense that the Federal Reserve, they're already talking about doing 2 rate increases and Jay Powell had several testimonies here over the last couple of weeks where he really stuck to the guns. Two increases, most likely next two meetings, which would be July and September. And they're really talking about quarter point increases. So, it wasn't that long ago. It was last summer they were going 3/4 point, which is a big one. So, nonetheless, I think that's going to be more of the focus here. Is that that things are still too strong. The job market is still too strong. The consumer appetite for spending is still too high, and we might see some motion upward here. With one caveat: the one way we can keep going, keep a soft landing in place, keep the Federal Reserve to 2 increases instead of more, is by an increase of supply, right? And so if we go back here, so the overall inflationary environment, including food and energy, is coming down nicely.
Yeah.
So that means food and energy is coming down. The demand for food and energy is not coming down, right? Matter of fact, the demand for energy continues to go up as the world reopens, as China reopens. But what's happening is the supply is higher. It's coming online. So we're getting energy coming in, we're getting food coming in, and that's still getting more expensive. You can see it's still 3.85%.
Yeah.
There's still some growth there. It's not like it's getting cheaper per se. It's just not growing as quickly. Yeah. Because there's inflation and then there's deflation, right? Which is where the prices go down.
Yep.
And that can happen. You were talking about eggs, right? It went up, way up, and it came back down. And then there's disinflation, which is the one in between where things come go up slower. So we're having disinflation in energy and food, and that's because supply is coming in. So when we get back to core, if we want to avoid, lots of rate increases, the one way that can happen is if we see more supply coming in. Now, this is very heavily oriented around services for PCE. Services take labor. And so when you see the job numbers, how many jobs were created for the month before, they've been very high. That's excellent, because that's what needs to happen.
Yeah.
We need to get more and more people back to jobs in these places where the demand is.
Yeah, and like labor force participation is like what, a 15-year low, and it's coming back, but after the pandemic it hit such a low.
Oh, that's for sure. And it's still coming back and coming back nicely. So anyway, that's the overall kind of take-home message. I think this is a very, very fascinating time frame. Things are doing well at this time and place. We should celebrate that, have a chance to continue to do well and continue to have a stock market growth with inflation continuing to at least stay where it is or come down. I think that has a lot to do with supply. Demand is growing here. I can feel it. You can tell what's happening. And people are not afraid of the stock market. There is still probably a tremendous amount of money on the sidelines. Right? And because at the end of the year, Bank of America had a big study survey of the big money managers, pensions and what have you. They were at a 70-year low in terms of their exposure to the stock market. And so that money's going to come back in. It's one of the reasons why, if you look at that chart, we're getting a pretty steep increase here.
Yeah.
And that's because there's short covering that happens. And then there's this money that's coming in off the sidelines, because if you're one of these big money managers who's been saying the market's going to fall, and you're sitting on the sidelines, you're getting crushed. I mean, if you're being compared to the S&P 500 or whatever index it is, you're being crushed, and eventually that pain just becomes too much and they start jumping in, and then of course it goes up further and then more people are jumping in, and that's how these bigger runs happen. And again, if you look back, I always bring this up, but back in 1982 when they finally got inflation under control, it was 106% gain that year on the S&P 500, and I'm not saying we're going to do that here either, but it just shows you the power of that money that's sitting on the sidelines all coming back in, and then everybody's kind of rushing back in because you're competing. We compete with these indexes all the time, and it's not easy because they're always in.
Yeah, and there's a similar thing happening with high net worth people. They were saying that compared to 2022, they had 10% more in cash, like cash equivalents, than they did the year before.
Yeah, and rightfully so. It was a pretty bad year last year, right? I mean, you look at where do you go? I mean, the bond market, the 10-year Treasury market in 2022 had its worst year since 1783. That's pretty bad. So you don't want to be there. That's where the banks were, and that's why we had trouble with some of the regional banks. They like those type of little longer-term treasuries. It's kind of how it works. So yeah, exactly. But now things are starting to improve. Bond market is still, let's show the bond market signal. Actually, forgot about that one. And so there we've got, still have a yellow on the slow signal and green here on the fast signal. So nonetheless, picking up, we're almost all green. So we'll see how it goes here. All right, so that's our summary for the week. I really appreciate everybody kind of sitting through that. I look forward to being able to talk about that again next week. All right, so let's go to our first question. What do we have question-wise?
When do I move on from an investment? What factors should I weigh when I decide, should I sell this thing or should I just keep holding it?
Okay, so when should I sell something or not? There's a lot. That's a big. I could write a book on this subject alone. So, a couple things for me that jump out when I hear that. Number one is this concept that for me it's a visual. I played soccer, right? So I use soccer. So I have a team. My team is on the field, right? Mm-hmm. Those are the best players. Matter of fact, I coach soccer too, so same thing. And so you want to have your best players on the field, and you've got people on the bench, right? And so the first thing I would say is, who's on your bench? Are they doing significantly better than that position that you're talking about? Because if you have it invested, it's on the field, it's playing. Yeah, you've chosen it, and so we're constantly analyzing every single player that's on the field versus everybody that's on the bench. So we have 174 ETFs in our universe. That's our bench, yeah? And at any point in time, probably 20 to 30 different ETFs are on the field. We have a variety of different models from, 10% stock to 100% stock and different types of, portfolios, all kinds of things. So everybody else is trying to get on the field. So that's the first thing that comes to my mind, because that's what we end up kind of dealing with on a daily basis. But there are lots of other considerations. Yeah.
Yeah, it's like one thing is the tax. Do you have a large capital gain? Is this a taxable or tax deferred account? That can make your decision process a little bit different, because I may keep an underperforming stock that's still performing, it's still growing. But because I have a sizable capital gain, I'm not going to sell it, because even though I can get some more gains for another stock, because after tax, it's probably a wash.
Yeah, exactly. Put up our stock signals again real quick. And essentially this is why we have two different signals, because exactly that. The fast signal and the portfolio I just showed you in the summary was from the fast signal. And that is designed to be moved more frequently because we use that in IRAs and Roths and those type of things where we don't have the taxation. So you do have to consider tax. And so the slow signal we use for those, and it's meant to be more of a buy and hold. We use different holdings that don't have as much, volatility in them, so we have to get out of them. And so really, tax is a big consideration as to whether or not you should keep or sell that holding. Because look, you're going to lose 20-30% potentially of the gains.
Yep.
Yeah, like you said, it's very hard to make that back. Another consideration for me, just to do, I'll give you an example. So back in 2020, we were riding a wave that was unbelievable. Clean energy, technology, genomics, you name it. It was just running and running and running. And we did fantastic from that run, but come the beginning of 2021, explosive January for those things, but then middle February started to fall off.
Yep.
By March, we were out of those in our IRA type assets. By the end of that year, we were out of all of them, even the ones where we had to take gains. And so when something triggers a downturn for us, so again, what's on the bench? Is the bench doing better? In that case, it really was, because a lot of those pieces fell 20 to 60%, from their highs. And so, I have technical rules that I use, and I look, and it just kept breaking through those technical rules, and you could see the momentum, and so we got out as far as that goes. that's beyond the pale of this whole conversation, because it's, again, write a whole book on the technical cues that you use to get out of something. But I will say, have a universe, and have that universe, tell you where to go. So if the other conservative portions or other areas in your universe are taken off and what you have is doing terrible, consider tax if you need to. But otherwise, you might want to make some replacements and keep that thing rolling.
Yeah, and you don't want to hold an investment too long, because once you start losing money, it takes a lot more effort to kind of go back up.
Yeah.
And so
Yeah, exactly right. We have a visual for that. Let me share that. Yeah.
and you can kind of see, like, once you start to lose 50%, you have to basically have 100% gain to get back to where you were before. And so you don't really want to hold on to your losers. And that's a lot of, proficient day traders, they let their winners run and they cut their losses quicker.
Yeah.
And that's how, even if they're not like just a like a 50-50 on if they do a trade well, if they have good, profit taking and selling, they can always be a profitable investor.
Yeah, and so you look at this, the 50%, just do the math. So if you got $10 and it drops to $5, okay, now I got to make $5 to get back to 10, but I'm at 5. So I need 100% rate of return from that point to get back. And so, because that gets kind of confusing. Somebody's, I'm down 20%, I need to come back 20. No, you actually have to come back 25%.
Yep.
If you look at this chart. And so that is exactly right. So you want to kind of monitor those situations to make sure that, you're not getting too deep into it. This always then combined with the thought process of, hey, this could come back. And it can. I mean, look at NVIDIA, actually, it got hammered. Yeah. And versus almost any rule you could have, you might want to have sold NVIDIA last year, right? Well, I think down 40% maybe from its high, something in that neighborhood. And now, last I looked, it was up over 180. It's up almost 4% today, up over 180% so far this year. So it's doing okay.
Yeah.
And so there is always that aspect of, even if it wasn't taxable, do you sell? And of course, those NVIDIA stories are what make you lose a lot of money, because now you're holding on to all your stuff, hoping that it turns into NVIDIA. So you do have to be careful. It's why we advocate for large holdings, this kind of fruit tree concept, where when it gets real high, you take pieces off to get it back down to some number that you're willing to hold on to. But so this is a great question. It actually goes to the core of really the asset management and how to deal with it. And I think it's a good example of thought process and how you get through some of these things. All right, what's our next question?
How do you tell if a trend is a lasting one and not a bubble? AI has been hyped up for the last couple of months, but could it be just like the crypto? That was a bubble that kind of popped and then wealth disappeared.
Well, that's an interesting correlation between crypto and AI. I would say one of the key things that jumps out at me is just the difference between those. Crypto currently has no use, right, of any substance. I know there's some things that you can do with crypto, but generally speaking, it is just you buy it, hope somebody else is going to buy it at a higher price, right? AI actually does something, and very popular, lots of things that it's possibly going to do, right, in the future. But here's a pretty cool chart that was explained to me some time ago, and this is a really good way to look at it. So if you look at the first part there, it says hype cycle, and there's a little dash line there that says perceived market opportunity. That's where we are right now with artificial intelligence.
Yeah.
There's this perceived, value that people can see, that they're excited. NVIDIA, has been running hard because they're kind of the
child.
Well, they're the ones making the jeans, right, for the gold rush, picks and shovels, and that's generally where the money gets made. A lot of times is in the people supplying. During the big .com bubble, Cisco was doing great because they were providing the backbone servers and routers that were going to run the internet, right, which turned out to be true. But there's this hype section where it just goes crazy. We saw this with clean energy. We've seen it with almost everything, the .com thing. And then there's facing reality, the next piece. And so this is where that's a ways off.
Yeah.
Usually the hype cycle is just early is the issue. And so they look at it and say, okay, that's going to be a while before this happens. And so we're going to go over here and put our money someplace else because these companies are reporting, losses most likely or
Yeah.
something along those lines. And so it comes back down. You can see that other dotted line where some of these just fail. They get washed out.
Yeah, you got your, your WebMD or your WebWAN or stuff
Yeah,
like that.
yeah.
These are technologies that we probably use today. WebWAN we would have been using
Yeah.
if they'd come 5, 10 years later.
One of the hottest stocks in the dot-com bubble was eToys, and it was much hotter than Amazon. Nobody knows who eToys is anymore, but we all know Amazon. So there are some winners and losers. It can be very difficult to figure out which ones to buy. It's one of the reasons why we use ETFs, exchange traded funds, because we can buy a big basket of them. So if we want, like we have an artificial intelligence robotics, basket through iShares in our traditional model right now. And I don't have to worry about getting the right one, going to buy most of them.
Yeah, and the nice thing about this is, you might miss out on the hype cycle, but there's still value to
Yep.
be made if
Yep.
you are able to say, okay, now you've seen it kind of run its path, and now, some of the, players have kind of weeded themselves out. You can still have that sustainable market.
Yeah, so that's that next leg upward. It says lift off to ultimate market opportunity, right? Now you look at that dotted line up above there. It says the real opportunity was actually higher than the perceived. That's true for the dot-com thing. The perception was the height cycle really ran and such, and then things failed, and bingo.com went bye-bye, and all these things. But the reality was that is a really big market. I mean, it's huge. It's changed the world. And so we've seen older technologies sort of kind of go through that. And so we've seen like clean energy is more in that lift-off arena now. It's actually being used. There's companies making profits.
Yeah.
And eventually it gets up into a sustainable market. But artificial intelligence is in that hype cycle. There's nothing wrong with that. You can make money in the hype cycle. Just be aware that it is the hype cycle and that very, very likely you will see these things fall off and come back down as they face reality.
Yeah, and that's the nice thing too, is because it's also a buying opportunity.
Yeah, exactly. Yeah, once it does come back down, there's still, it's still going to keep going. So it's a great question. It's really interesting to me, that cycle and kind of knowing where the investment is that you're looking at. Where does it fit into that, overall spectrum of, hype, face reality, ultimate, gains, more mature. That's important to know.
So what is keeping inflation so sticky? It's like, as food and energy prices have become kind of like a non-factor, we still have inflation.
Yeah, no kidding. The top line inflation, which includes food and energy, is coming down quite nicely. When you take out food and energy, you can see that the core inflation, what they call core inflation, is actually kind of flatlining for the most part, right? Kind of going sideways. And why is that? Well, really, it has a lot to do with kind of, what's in those baskets and what's still gaining. So we're seeing rents, be a big area that continues to hang up there. Rents are tough to analyze, and we're seeing the service arena kind of running.
Services is holding pretty strong.
Yeah, and so it really, consumers are continuing to go out and do things, and that's keeping things sticky. And their job market's healthy, so people are making money, right? So that kind of keeps things sticky. And it really, just continues to hang out there. It's not at 9% or what have you like it was. So that's really, really damaging. Although we were talking from somebody in the UK over the last few weeks, and they're still hitting that kind of 9 to 11% inflation rate. So it's not rosy as it is here everywhere, but it can be very difficult because one of the things that happens is if your costs are going up, you go back to your boss and say, hey, I need some more money, right? And then the company says, all right, it's costing us more, so we need to increase our prices. And so far, companies have been increasing their prices.
Yeah, right? and we're starting to see where the company's price power is starting to erode. I was reading some article about how cereal companies are grumbling that they can't keep raising prices because they're facing a demand issue because of that.
Yeah, and that's the problem with inflation for the stock market concern, is just exactly that. When that company gets to a spot where it's increasing costs are happening because of inflation, higher labor costs, what have you, but they can't increase the top line sale, right? That's a problem because what will happen is it'll start to eat into their profits. That's the only thing. I mean, if you're staying flat with your revenues and your expenses are going up, your profits are going to get smaller and smaller. And those earnings, those profits, that's what drives the stock market. That is what drives it. And so when those fall out, and that is the fear here. So far, there's been enough pent up demand and enough consumer interest to kind of overcome that. Certain areas are struggling a lot more than others. And we're talking about the whole economy as a whole is doing quite well, actually, compared to what it was supposed to be doing. That's for sure.
Yeah.
So I think that, part of that is that you're going to have high inflation if people are willing to pay it, or willing and able. Yeah. When inflation gets to a spot where people are not willing to pay that any longer or unable to pay that any longer, that's when things start to come down. And that's what the Federal Reserve is trying to do, is trying to get things so that, it slows it down enough. And it's not slowing down as much as they'd probably hoped. But at the same time, we're also not having a big hard landing recession either. So, we're doing okay as far as that goes. But it is that sticky inflation. I said this, in the summary. I feel like this is actually one of the key things to be watching. Not so much the recession, because I think it's going to be a higher inflation that comes first here, if I was to guess.
It'll be interesting also, just sort of kind of a random thought that I had, that, student loan debt was kind of, blocked by the Supreme Court. And could that be a help with inflation too, because consumers won't have as much discretionary income? Yeah,
exactly right. I mean, they're going to have to start making possibly payments again on the student loans. And so that's money that isn't going into the economy, at least directly. Theoretically, it goes into those loans and probably goes somewhere. But, overall, yeah, exactly right. What other things are out there that are causing a drag, and could slow things down? And that's I've forgotten the exact dollar amount to those payments, but it's fairly large. So could make a difference. Get that big group back to paying again.
I think there's 40 million people with student loans in the U.S. So having them have to start paying again is a pretty big drag.
Yeah, sounds like it. Okay, good. Got time for one more question.
How does spousal benefits for Social Security work? I'm a non-working spouse. Does me taking my benefits affect my partner at all?
Okay, a lot to unwrap there. So first, a non-working spouse. There's two different types of non-working spouses. One who doesn't have enough quarters to qualify for Social Security, and one who does.
Yeah.
Right? And so when you take your spousal benefit, it's going to be half of your spouse's benefit or your own, whichever is higher. And it does not impact your spouse. Matter of fact, you can even take half of your ex-spouse.
Yeah, if you've been married for 10 years or more.
Right, which a lot of people don't know. So you can have 4 ex-spouses and pick the highest one, as long as you're married to all of them 10 years or more. It sounds like an awful life, but nonetheless. And so anyway, you get to choose between those two. Take your own if it's higher, or take half of your spouse's if that's higher. Now, there is a caveat, though. If your spouse needs to or should delay taking that, then you can't take your half until they start taking theirs.
Yeah.
Because a lot of times when we run an analysis for somebody who has the money, it's better to wait till age 70. Well, that means the other spouse can't take the half of that until that 70 comes along for the primary earner's spouse. And so what you can do, though, is you can take your own.
And if you have enough credits.
If you have enough credits. And you can take your own from 62 to any time. And then it jumps up. Let's say your own is 500 and half of your spouse's is 1,500. Take 500, and we can do an analysis actually to figure out when you should be taking that 500. And then once the other spouse, the main earner, say at age 70, now you get 1,500, right? Your half continues to grow up to a point.
Yeah.
Right.
So your half is based on your spouse's retirement at their full retirement age.
Right.
And so after that, even though a lot of people, it's 67 right now, and they can delay till 70, your spousal benefit will not grow if
Right.
they delay. So once that hits that 67 years, it kind of caps out.
Yeah, exactly. So if your spouse is at 3,000 by full retirement age, so 67, let's say, for example, and they're not going to take it, they're going to delay, and because they get 8% a year growth plus the cost of living increase for those next 3 years, so let's just say, I'll just make up a number here, it grows to 3,500 from 3,000, right? You're still at 1,500, the half of what you would have had at full retirement age. It doesn't grow to half of that 3,500, which would be 1,750. You're still capped out at 1,500. And so again, it matters whether or not you have enough credit, what you have, in terms of your own Social Security versus what the spousal benefit is. And so it's really kind of fascinating, but it does not impact the other person. And even if you're taking half of your ex-spouse, that doesn't impact. They don't even know. It doesn't matter, and you don't have to wait on that one.
Yeah, one thing you do have to wait though is, are you full retirement
Yes.
age? Because if you take before your full retirement age, your spousal benefit is also reduced.
That's right, exactly right. I think it goes down by roughly 5.5% a year, or you could look at it the other way. It goes up 5.5% a year between 62 and your full retirement age, something in that neighborhood.
Yeah, so it can depend. Like if you take a year early, you could be down like to 43 versus the 50%.
Yeah, exactly. And so that's Social Security maximization is a really incredible area. There's a lot to know about there. So if you ever want to, really learn about that, set an appointment with us and let's dig into your specific situation, because what we're talking about here is somewhat generic, and your situation could be different if you have a pension, a participating pension, a non-participating pension. There's a lot of pieces for Social Security. It's very complex. So, and unfortunately, the people at Social Security are really instructed not to help you just because they need to know every detail about you to give you the right answer, and they can't do that. So
Yeah.
they just basically don't give an answer.
They'll explain the rules. So
Yes.
they'll say, yes, if your spouse is taking, you can take spousal benefits, but
Yep.
they won't go into the nuances.
That's right. And the nuances are how you maximize your Social Security. And that's where somebody like us, like a financial planner, can come in and really help you do Social Security maximization planning. So good stuff. All right. So that's it for today. Really good show altogether. Thank you so much for coming. Again, send in your questions. We love answering them. Send them in during the week. Give us some time. You can see we got some of these during the week, and we make some visuals and kind of enhance the answers. Also, you can subscribe to the channel. That helps us. We're actually making a big push to try to up the subscribers on the channel right now. And you can set an appointment with us. Just meet with us. You want to talk about Social Security? You want to talk about whatever it is that is of interest to you? Book an appointment. You go to our website and pick out a time, and we'll see you then. So I want to thank everybody so much for coming. I look forward to seeing you again next week. Thank you.